entrepreneurial real estate investors and buyers that have some bank relationship or can get their eyes on deals before they hit the market, if this happens, they will have the opportunity to capitalize on this asset migration.
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, this is Augustino. Your lender is your biggest partner on the deals you're putting together. They'll sometimes come up with 60 to 80% of the equity that you need for your deal. Now, with that being said, having the right lender on your side is critical to lining up the right deal with the bank. Well, today's guest understands this concept very, very well. He has more than 15 years of experience in the commercial lending space and has closed over $1 billion of real estate transactions. Additionally, he has advised borrowers on hundreds of multi-million-dollar real estate transactions, including complex, multi-layered capital stacks and the repositioning of large multifamily portfolios. He is a member of the 2020 Forbes Real Estate Council and is published in the Housing Wire and other industry trade journals. As the founder and CEO of Janover Ventures, his real estate advisory firm focused on the origination and of commercial, multifamily, and residential real estate loans. With all that, I'd like to welcome my good friend, Blake Janover, to the show. Hey, Blake, thanks for coming on, man.
Hey, Augustino, thanks for having me. And you gave me a little bit of a script over here. You wanted me to say that I am more excited about this than I would be for a TED Talk, and I've been waiting my whole life for this second interview. So I, from the bottom of my heart, I thank you for inviting me on again.
Thank you. Thanks for coming back. I appreciate it. Well, guys, if you like what Blake has to say, you can reach him via his website at multifamily.loans. And if you like our content, please don't forget to leave a comment and rate the show. It helps us out tremendously when you do. Finally, if you text the word freedom to 202-410-4202, you get our free ebook, The Bulletproof Guide to Finding a Broker. Okay, Blake, go ahead and tell listeners about how you got your start.
My start in real estate finance was a little more than 15 years ago. I was originally rating proprietary trading algorithms for a small fund, and a buddy of mine who actually works for us today, which is quite cool, had put together this marketing list for mortgages. This is like way back deep in the last cycle. And we ended up arranging for a mortgage lender to buy the list, and I went to go work for them. And I kind of quickly elevated from I was a teenager, right? I don't know what I was, like 19 years old. I went from, junior guy to best sales guy to kind of running the floor. And then I left and I started my own shop from home and hired my buddies. It was quite cool, like out of a movie, right? The whole apartment was these like big CRT monitors and these were like huge Dell desktop computers and wires for wired phones all over the place. And, that was kind of like the beginnings. This is very early the early 2000s. Quite feels like another lifetime.
It does often feel like that, right? So long ago. But since then, now you have your own firm and you're originating all kinds of crazy loans right now. And as I mentioned in the introduction, you guys have originated north of $1 billion of deal transaction, which is phenomenal. That's great stuff.
Yeah, it's been the career has been high velocity. We kind of launched as Janover Ventures, right? And folks can visit us at multifamily.loans, but they could also go www.janover.ventures. That's kind of like the parent company, the holding company, which owns all of our brands, which includes CMBS.loans, commercial real estate.loans, HUD.loans. The list kind of goes on. So right now we're building a kind of like a digital marketplace that's connecting commercial mortgage borrowers with commercial lenders, and we're like reducing the frictions in this process. Because as you know, as any seasoned investor knows, this is a highly frictioned process that's kind of like a black box. And so we're trying to like remove that completely. And right now, through all of our web properties, which are primarily educationally based, we're seeing something like $2 billion a month in online applications.
Wow.
And we're just like clawing our way through it to kind of ramp up because the demand is unbelievable.
Let's talk a little bit about that, because obviously right now, we talked about this in the green room earlier, capital markets are in turmoil. There's a lot of stuff going on right now. A lot of loans that were underway are suddenly getting pulled, getting rejected halfway through due diligence, or even on the way to a closing, for instance. what sort of things are buyers or sellers encountering when they're coming to you with a loan? Are they typically looking for help, or is it a mix of other things? Like what are some of the causes of all this stuff's happening with?
Well, so there are a lot of components to that question. So to speak to the turmoil in the markets, I think you used the word turmoil, and boy, that would be the understatement of the year, right? It's um, it's a bit chaotic. So uh, a lot of loans changed materially from when this COVID thing really became prevalent in early March. So people that had loans with banks, banks may have just canceled the loans or materially changed their stipulations so that they could get out of their loans. Many lenders, non-QM, smaller type lenders, I'm not going to name any names, just pulled the plug on all their commitments on all their deals, just completely stopped lending. Um, there's Fannie Mae and Freddie Mac, which we do a lot of. Uh, they never pulled the plug, and they never will, right? But what they did was they changed their reserve requirements. So you could have signed up for a loan at 80% LTV in the middle of March, and by the time you hit early May, Fannie or Freddie may have said, "Yeah, so we're giving you the same loan and your rate's a little lower, but we're going to need 18 months of principal and interest reserves." I kind of want to keep the content evergreen, but what's happening in this market is that in order for them to limit their exposure, they're keeping the loan amount the same and they're just loading up on the reserves. You're getting like a net 65% LTV. So we're seeing a lot of, we've seen purchases really slow down materially, but we're seeing a lot of refinances because rates are really low. But a lot of the refinances we're seeing are pretty low leverage. We're seeing a lot of stuff 55% LTV, which is it's nice to know that there's some people out there that aren't levered to their teeth. Not that there's anything wrong with that, especially if it's non-recourse debt. But that's kind of like what we're seeing and feeling now. And one other thing, because we've got a bit of a marketplace here, when some of our small lenders kind of just went out of business or just temporarily turned off the lights, we were able to really comfortably pivot to credit unions and from banks to Fannie and from Fannie to banks. And I wouldn't say that the process has been particularly comfortable, but we've been able to continue to execute and continue to grow, which is and hire, right? Like we're hiring and growing, which is cool because there's a really easy case to make for struggling and shrinking.
Yeah, absolutely. I mean, man, right now it's something you pointed out is the reserves, right? It certainly is tough for many people to expect they're going to get into a deal with 80% leverage. And then next thing you know, you get to the closing table. Oh, by the way, now it's 65.
Right. If they get to the closing table and we want to see 12 months of cash in the bank and we want to see 18 months of principal and interest held in escrow. And it's still 80%, but you have to come up with another 20% more, or
right.
whatever the number is. Yeah, it's pretty outrageous.
Right. But
there's been some sticker shock.
But you have enough time, I guess, to I guess raise that extra money, right? Because now you're having to raise that extra money that's going to dilute the LP a little further, depending on how you're set up. But you're kind of like you're stuck at this point, right? I mean, you have no other choice as if you're syndicating the deal anyway, right?
Right, but there's absolutely that's the only really your only reasonable option when time's not really on your side and you've got a deal locked up. Going forward, there may be some kind of growing disparity between bids and asks because bids represent a need for IRR and asks represent whatever a seller's expectations are. So for these like plain vanilla deals. In the short term, there might be some spread between the bid and the ask because of the lack of financing. And I wouldn't say this is in like the institutional market, but certainly in like middle markets and lower middle markets. But the long term, gosh, I wonder even with a little bit of contraction of NOI on the P&Ls, I wonder how low cap rates could go when the 10-year treasury is like really pays you next to nothing. Right.
Right. I mean, that's going to be very interesting to see. I mean, I think we're gonna see more in the next few months here what happens, considering where it's at today and where it's going to be going. Now, this money that you put aside to put into escrow, at what point does it get freed up, or does it ever get freed up? Like, just to be sitting on a year or 18 months of money not doing anything is kind of expensive, right? I mean, is there a certain time frame where maybe that syndicator will have access to it?
Yeah, so it's changed. So it's really depends on the lender, right? Like some like CMBS lenders are implementing this now. It really depends on the lender. So, and it's so what I could say is for Fannie, for example, it's changed multiple times. So the most recent change was it will be released 12 months after you've demonstrated um, X consecutive quarters of hitting your debt service coverage ratio. Um, but you wouldn't believe how many times I've gotten updated guidelines from Fannie, Freddie, FHA, CMBS lenders. So this is an extremely dynamic environment. The one thing that does seem to be pretty static is that you are getting the money back in a year or two, provided there's no substantial hiccups in economic occupancy. But we haven't really entered that stage where it's really gonna show, right? Because I just don't know what happens when this $600 a week thing drops off. I have no idea how that's going to correlate with collections in B and C properties.
Yeah, that's going to be tricky to see. I mean, right now we're seeing in our B and C properties, things are still performing. The most of our tenants are working the just regular either blue collar or other type of service jobs, right? So they're holding steady, but some of the other folks, some of the lower C class assets, yeah, there's a bit of struggle going on there. There is. I mean, it's still performing, but it's certainly not like it was back in, like, say, January.
There's a reason that these small, 8 to 20 unit, like super tertiary market D, C minus buildings traded at, 14 caps, right? Like if you bought something in like a really scary neighborhood in Memphis, at a 14 cap, and it's like an 8 unit or a 20 cap, right? And it's like an 8 unit, and you need a Teflon vest to collect rent. Like these are the places that are going to get hit hardest and first. So there's definitely going to be like some good resiliency. By the way, without like disaggregating multifamily as an asset class into like little markets and classes and everything else, but like overall, multifamily has proven to be even counterintuitively resilient during this crisis. I don't think anybody expected collections to be as high as they are. It's really it's really remarkable.
Yeah. Well, the thing is, though, you're absolutely right. I mean, everyone's told to stay home. So Maslow's hierarchy of needs says everybody needs a place to live. So if you're providing the housing, you should be getting paid. Should being the operative word. We don't really know how those individuals are getting their money. Maybe it is through some sort of government subsidy. Maybe it's even because they're racking up a credit card, pulling cash out of it and slamming it into their rent so they don't get evicted. I mean, we don't really know, because we know that the savings levels for most Americans is actually negative. so there's that, right? I mean, but the long-term effect of this, let's say, for instance, after we get through this and the government funding dries up, I think there's going to be a lot more people carrying some credit card debt too. I see that happening, right?
Yeah, and the credit card companies learned in the last cycle where like the first defaults happen, which are in transfers, when you do those like 0% balance transfers, and most of the big banks cut off balance transfer programs immediately. Americans right now have a higher proportion of savings than they've ever had before, right? Like courtesy of Fed printing money, and banks actually have more. I think it was like the biggest jump in deposits in like the shortest period of time in history. I think they had like a $2 trillion jump in deposits. So it's actually like banks are flush with cash, but they have no idea what their assets are worth. They really and I have to shout out my boy Joe Nolan, who shared with me this article in the Atlantic about banks exposure to CLOs. But it's going to be really interesting to see what happens. What happens with banks? What happens when government funding cuts off? It seems like, uh, anecdotally, that Class A stuff might perform really well, uh, because or like might be surprisingly resilient because a lot of these like knowledge workers, white collar folks have kept their jobs. There may be like a really big, this might really contribute to expanding this wealth gap. There's so many unknowns.
Yeah.
I feel like we're going to learn a lot in the fourth quarter.
Yeah, that's right. That's right. Well, from what I understand, we are now, as of this recording anyway, we are officially in a recession, right?
Right. Seems
Officially.
like a bit of a lagging indicator, right? The,
Right.
the
Right.
stock
Well,
market dropped like more than ever and then bounced more than ever. And then it's like, oh, we're in a recession. The
right.
recession might already be over, by the way.
That's right. That's right. Exactly. Exactly. Because it certainly doesn't feel like a recession, like the typical malaise of a recession. If anybody recalls from 2008, 2009, it was just insanity. Now it just feels a little different, right? But these days, then, what sort of things are you seeing then in terms of what else is what else are lenders doing these days to really hedge their bets aside from some of the Fannie and Freddie doing, as far maybe say the credit unions, regular banks, like what are they doing to hedge their bets to make sure nothing bad happens to the assets there?
I can't speak really well to the hedges, right? So I think there's a lot of silent prayer that's going on. There's workout divisions that are being rolled out. There's a lot of, gosh, what's the expression? Extend and pretend, right? So there's all these forbearances going on, and businesses got PPP loans, so they're able to pay their bills for a little bit longer, but we don't know what's happening next. Uh, I wouldn't be surprised if there's a wave of Chapter 11s that start to happen. I've seen, like, personally, bank lenders that I know, I've seen some of them just kind of stop lending completely. They're just in a holding pattern. CMBS lenders are kind of in the same boat. They got to make sure they can securitize their stuff. They can't really afford to keep more on their balance sheets, which are highly levered, generally speaking, with warehouse lines. So I would say there's a lot of uncertainty. Some lenders are saying, well, what kind of loans can we do that carry the best uh, kind of federal guarantees, which is why Fannie, Freddie, and FHA continue to go. USDA will do okay. SBA lenders are starting to test the waters a little bit, but I've seen some of these SBA lenders that are carrying a lot of SBA 7A loans just sell them,
Hmm.
to shore up cash. Uh, so I can't speak to what the CFOs are doing to create hedges. Um, I don't know if they're loading up on credit default swaps like they did in '08, but I think everybody's just kind of playing it slow right now.
Yeah, yeah, a little bit of caution that's going on out there. A little bit of caution.
Sure,
I
so
mean,
much uncertainty.
yeah, exactly. And we know that banks don't like uncertainty, like this is happening now. So there's one strategy that people are employing that I'm hearing about anyway is um, if someone wants to purchase an asset, they're not necessarily going about of assuming the loan, but what they'll try to do is have the buyer contact the seller's bank with their permission, of course, and try to, I guess, qualify for a loan with that lender and transfer the asset. Basically, is that? Have you heard of doing such a thing? What do you think about that strategy?
I haven't seen a lot of it, but if you ask me what I think about it as a strategy, I think any strategy where you're like uncovering and exploring any option you can in order to take down a good deal, I think I think that's what's going to separate the guys that can execute between the guys that can't get the job done. So
Mm.
if you've got a deal that's priced right, and it's high quality, and you believe in your projections, then you should there should be a scorched earth approach to how you can best execute with the least amount of risk. This is the kind of time where it's worth possibly paying a little more, or losing a little bit in rate or fee or what have you, to ensure certainty of execution. And that could, and your approach works, having an all-star financial intermediary or a great marketplace. It can work. I think that for the coming few months, people are really going to have to wear their creativity caps. It's like what they used to give me in kindergarten. They'd say, "Put on your creativity hat." Now is the time.
Well, that's the best time to apply it, right? Whenever there's slowdowns like this, because I think if you're going to want to get that money with the valuation out of those assets, you're going to have to get creative, because I would imagine anyway, if you're going to try to ask a couple $100,000 more than what you paid for an asset from even 2 years ago, chances are these days it's going to be tough to get it unless you apply some sort of creative methodology. Because the way I see it is, let's say, for instance, you did apply this strategy where, okay, great, I have a buyer for an asset. I'll line up with my lender. My lender may say, well, that property is not worth that much anymore. Now it's worth X.
Right. Well, I think that's something that you're gonna I didn't mention it, but the first thing I thought when you said it, I don't know why I didn't mention it, was the bank probably just wants to get paid off.
Yeah.
So they might say, no, we're good. This guy that's been paying us and owns the property is a known, and this new buyer is an unknown. And the thing about something about the devil you know and the devil you don't, et cetera, et cetera. So if you got the cash on hand and it's like a stabilized qualifying deal, I still think that the most guaranteed liquidity resides with Fannie Mae and Freddie Mac. It just and maybe my perspective is skewed because I'm so like deep into that part of the space. But I'll tell you what I do see. I do see credit unions, small credit unions, making loans like physically close to them. So if somebody's struggling with a deal, you may want to look at the property on Google Maps and go pull up credit unions that are close to it, or banks that are like First National Southern Bank of City, County, State. One of these 3 or 4 branch locations, because those guys are and will continue to remain very very sensitive to the geography of a property. And if you're close to home, they feel good about it.
Right. They know the market, they know the area, and they are willing to invest that money into that deal. And as opposed to some out of state group has no idea what's going on in your neck of the woods, and they may not feel comfortable doing a deal in, where X place, Tennessee. They don't feel comfortable about it, right? And these banks have to put money to work. I mean, they still have to do something with this cash. I think you said this earlier. They're flush with money right now,
more
right?
than ever.
Yeah, they're flush with cash, so they got to do something with it.
$2 trillion new dollars of deposits. My stat might be wrong, but I think that's what it is, and it's an unfathomably huge, unfathomably. I'm not even sure if that's a word. It's right. It's a big number. 2 trillion. It's a T.
It is. And that's actually might be a really good strategy for those guys out there, even for smaller deals. So even for deals less than $1 million, might be a good way to find a lender that might be interested in doing those smaller deals. Yeah.
Particularly for deals less than $1 million. And the cool thing about credit unions is that generally speaking, they either don't have or they're prepaid light. So you could take down a deal with no prepay, and maybe a credit union's going to have a shorter amortization or a 5-year term, but it's like a very cheap full recourse bridge loan.
Yeah, that's a great way. So for you guys out there, definitely check that out as an option if you're looking for deals right now. Now I know that you're really big on Fannie Freddie. So aside from the 18-month escrow scenario, what other things are they doing these days to, I guess, protect themselves against any type of further downfall when you're looking at an asset as far as a buyer is concerned?
I think that I'm not sure I completely understood the question. You saying as far as a buyer's concerned?
Yeah, as far as the, I'll say it again. He's going to have to edit that anyway, because I don't know what happened. All right, I'll just pause for a second here. Okay, so I know you do a lot of Fannie and Freddie loans these days, right? So aside from the 18-month escrow deal, what other things are they doing to protect themselves in terms of loan origination?
Right. So first off, the reserves vary between the lenders. Like right now, I think Freddie's 12 and Fannie's 18, but Fannie will be 6 months under 65%, and they might waive reserves under 55%. So there's some tiers to it, but these reserves are extraordinary means of protection, right? Like unheard of. So there's not much you have to do besides that. Now, they happen to be just playing everything a little bit tighter. There's minimal exceptions for loans under $3 million as they find that smaller loans have a higher risk of default. They're being more conservative about the retail and commercial income that they're underwriting. They're playing it all a bit tighter. But I do have to say, an 18-month P&I reserve that's just sitting there, plus requiring 9 to 12 months of cash on hand of the key principals. I mean, you're essentially hedging most or all risk.
Yeah.
I'm not quite sure what the heck else they could do other than ask you to make the loan yourself.
Paying the whole thing yourself, right?
Right. Yeah. Pay the whole loan up front.
Yeah.
We'll lend you $3 million, but we need you to put $3 million in an escrow account pledged to us. So they're pretty safe right now.
Yeah, man, these are some extraordinarily crazy times these days. What other things are you seeing out there? What other sort of oddities are you seeing out there in the markets related to all this COVID stuff and all of this pandemic stuff? Like, what other craziness are you seeing in general?
Well, those 30-day defaults on retail and hospitality was unbelievable to see. I don't know how that's going to pan out. I'm seeing the rapid maturation of the buy side NPL market. The NPL, which is an acronym for non-performing loans. This market hasn't happened yet, but a lot of people are anticipating it will in like Q4 or Q1 as banks have to offload assets in order to recalibrate their capital, and lenders that securitize loans have to move stuff off their balance sheet because they can't profitably securitize debt. So I'm seeing the NPL market starting to mature. We're seeing unbelievable delinquencies on retail and hospitality. We're seeing just like an absolute freeze in hospitality capital markets. Deals that seem like slam dunks for anybody are just a hard pass. So that's some of the stuff, some of the things that stand out to me right now. I'd have to give it some more thought as to anomalies that I'm seeing outside of, just because everything's an anomaly now. So now, like anomalies are the new norm.
That's right. Well, but it's interesting you mentioned those non-performing loans. So when you're talking hospitality, you're talking about hotels, which took a huge hit. I mean, even Airbnb and some of their brethren, so to speak, some of them have gone out of business completely. So it's just been absolutely madness in the hospitality side of things. But when it comes to these non-performing loans, do you think there's going to be an opportunity then for someone to just start buying up some of those loans, and what sort of financing, if any, would be available for a larger type of deal? So let's say, for instance, there's a chain of extended stays or something along those lines. I don't even know how they're doing as a company. I'm just using them as an example. But what sort of financing opportunities do you anticipate, if any, would there be in for someone to acquire something like that in say Q1 or Q2 of next year?
So you're going to see a lot of liquidity come into that space. So on the middle market side, when you're looking at stuff, we'll just throw numbers, stuff from like 30 million to a gazillion, right? There's going to be a lot of buy side liquidity. These deals are going to get gobbled up. If they're clean deals, they're going to get gobbled up really quickly. But it's going to be subject to underwriting, right? And I don't know how anybody's going to underwrite these extended stays as what's the as is value, what's the as stabilized value, what's future occupancy and ADR, what does that stuff look like, or is this just some giant multifamily conversion opportunity? So that side of things, you're going to have trouble buying and getting financing because the buy side guys are so big, they're probably going to gobble that up. There's going to be a lot of opportunity, I think, under $5 million. The middle market will be competitive. You'll be able to take down big deals in this like $5 to $15 million space or $20 million space. It'll be competitive. All of the private money lenders out there that everybody knows, the Madison Realty Capitals of the world, they're going to be financing NPL acquisitions. They're going to be all about it. And if you're buying it right, they're going to be high on leverage, because if you think about buying, for example, a 70% loan, right? I'm buying a loan that's 70% of the underwritten value, right? Maybe originally I'm buying it at a discount, right? So it was like an 80% loan. I'm buying it at a discount. It's 70% of the underlying value. And then maybe Madison Realty Capital, for example, right? They lend me 70% on that. They've got a net 49% LTV and a pretty high IRR there. So they're happy to extend that. We're working on a platform for smaller NPLs under $5 million, where we're going to be able to finance up to 90 to 95% of the purchase price, subject to some underwritten value constraints. So entrepreneurial real estate investors and buyers that have some bank relationship or can get their eyes on deals before they hit the market, if this happens, they will have the opportunity to capitalize on this asset migration from like consolidated balance sheets and passed over to the private sector.
But I think it's something you just pointed out, though, too. It's those relationships. Those are the relationships you need to start cultivating, or should have cultivated already. But now it seems like it's even more important than ever to start building those relationships today. And it sounds to me like it's going to be more than just your regional branch here. You're going to need to have direct relationships with some of these very, very large lenders to get access to at least some of these deals that maybe, an everyday multifamily syndicator and investor may be interested in taking down, right? I mean, obviously taking down a chain of restaurants or hotels might be a little bit out of the grasp for some people. But that sounds to me like it's more of a corporate play. But if there's an acquisition to be made and say something a little smaller, it's now building those relationships today to express interest in with your banks, basically, right?
Yeah, and there'll be opportunities across the board, because even the smallest hard money lenders, for example, many of them have a credit line, right? And that credit line says, like, after they've got provisions and covenants that say that you can't carry this many defaults, that you have to sell a loan after this period of time or pay it off or something like that. So there's going to be onesies, twosies happening also. Something that a trap that an entrepreneurial real estate guy has to avoid is, or not avoid, but investigate or learn more about. If you're planning on doing this, taking down NPLs, you have to be really careful about the laws that surround taking the property back. If your intention is to buy the loan and then take back the property and then perform it, refinance, whatever, which is a very common strategy, certain states have laws that will make it more difficult for you to foreclose and take it back. And as some states, the judge might say, oh, all of that default interest that you were accruing, we've decided that we're going to roll back the default interest. You don't get any default interest. So there's a lot of things to chew on around the legal side of it. It's not really an easy peasy thing. So you might want to get Googling now, or aligning yourself, even better, aligning yourself with somebody that's experienced, where you could say, hey, listen, I've got a deal. Will you partner with me on this? I know you've done these before. So just wanted to float that out there.
No, that's great stuff. So do you know of anyone, or do you know of any groups or anything else like that, like, say, for anybody listening, how would they get their hands on someone that might know anything about NPLs, or even how to orchestrate a play here? Do you know of anybody that might be able to do that off the top of your head?
Off the top of my head, no. There's a couple influencers that are floating around LinkedIn. I probably know I do know a couple guys that broker NPLs. I could share that with you post show. Smart guys. But nobody that I can, but as far as like advising on the buy side or being a buy side partner, nobody that I could say. But I will provide you post show. I've got one buddy who's super smart, and he's a high performer. His name is Mike Jimenez, and he knows the NPL business in and out, so he might be a great resource.
Yeah, that sounds like someone, definitely, if someone's really interested in taking something big down anyway, don't do it alone. Get a partner, partner up with someone that knows what they're doing or has done this before, because you're going to do yourself a huge disservice if you try to take this on yourself, because it sounds to me like it's not an easy peasy thing to do, right? Very, very complicated. Very complicated.
Nothing worth getting seems to be too easy peasy.
That's absolutely true.
My wife being a perfect example of that. She was tough.
yeah. But tough, but worth it. That's right.
Of course.
Yeah. So now, for people listening right now, what sort of recommendations do you have for them to navigate the current turmoil that's going on these days?
Visit www.janover.ventures for the most up-to-date information. No, I'm kidding. But really go there. Look, you work with, now more than ever, you're better suited to work with a trusted advisor or intermediary than specifically with one lender. Even if it's a lender that you know and you have a good relationship with, your originator does not control the credit committee. And banks are going to be hypersensitive to risk right now. So if you have an intermediary that you've done deals with before, or that a colleague of yours has worked with, that they trust, that they recommend, that's the path to go. And as soon as you get an LOI signed, start talking to them about what the options are. If you can, start talking before you get the LOI signed, so you have a good feel for what to present to investors. Because if you're raising LP, there's nothing quite there's a few things tougher, but it really sucks to say, like, this is how I modeled the deal, and now it's changed. Of course, now's the time that those things happen, but better to model it right up front. So start having those exploratory conversations with the right intermediaries. And these markets are dynamic. So what is today won't be tomorrow. Times are a-changing pretty quick.
That's an understatement too, right? Jeez, it's crazy.
Yeah.
It's crazy. All right, guys. Well, if you want to reach out to Blake, you can reach him through his website, his company website at multifamily.loans. I hope you got a lot of good insight on the importance of not only selecting the right broker, as Blake pointed out, but also how to navigate some of the madness that's going on in the markets these days. All right. Thanks for tuning in, and I'll see you in the next episode.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast.